Hey, I'm Daniel Snyder from Seeking Alpha. Thanks for tuning in. Today is a special segment with a guest you might be familiar with if you've been watching our program for some time. We are joined by the one and only Andy Constan, CEO of Dam Spring Advisors. Andy, it's always good to talk to you, and I'd like to dive right in. You put out your portfolio returns and positions this morning to the public all over Twitter, and I couldn't help but notice your Dam Spring portfolio is up 14.5% year to date compared to the S&P 500, which is down a little over 5% a year to date. So obviously you're making the right calls. So what's your overview of this market, and what are you investing in these volatile market conditions?
Yeah, so performance has been fortunate. We had a bit of a drawdown in the first part of the quarter, but have recovered across many assets, rates, currencies, and equities, a little bit in gold. But our current portfolio is built for a continued improvement in what had been extremely negative growth expectations. The way I've described it is the bond market with 10-year notes at 170 and stocks down was priced to be almost certain that the Fed would send us into a recession. And that's really reversed. It hasn't, listen, I'm not optimistic about the economic outlook given the Fed tightening. And in fact, the Fed's actually got quite a bit more hawkish since then. So you can't be super optimistic about the outlook for growth, but you can be more optimistic than the depths of bond yields and stock prices, 2-3 weeks ago. And so we've had a big stock rally, which, is tempered by the fact that the Fed is in fact tightening. And a big bond sell-off, which is a double whammy of both Fed tightening, causing risk premiums to expand, and growth expectations recovering a bit.
Yeah, I just want to touch on this though. So you told us back at the beginning of February that your call is for equities, golds, and bonds, and almost all assets. They would just sell off during quantitative tightening by the Fed. So
yeah,
can you lay it out for us? Is this still your base case?
So I've written a lot in the last couple of weeks, and it's on my website at dampspring.com, about the lever that Janet Yellen now has. And she's always had it. I pointed it out a long time ago, but I've gotten it. We're coming to the point where we're actually going to find out how she plays. And she could have a significant impact on quantitative tightening. And that was always part of the game. If she does not pull the lever, and I'll explain what that is briefly in a second, the path for assets is poor. Quantitative tightening at what looks to be sort of, my estimates are starting as early as May, but probably June, and certainly by July, at the max pace they've ever done, initially at 50 billion a month, and then 100 billion soon after that, maybe 3-4 months later, and then just persistent $100 billion lack of buying through as long as they choose to do that is going to leave a mark on risk premiums, expanding them, contracting multiples, and contracting prices of gold, prices of all assets, prices of bonds. So that's my outlook for quantitative tightening, unless Janet does something creative. And that is she issues bills to fund the budget and the quantitative. So all right, let me step back for a second. Roll off is the Fed getting a maturity payment. And in the past and today, they use that maturity payment to buy more bonds and either keep their balance sheet growing or, as of today, keep their balance sheet flat. In quantitative tightening, the first phase, they'll do roll off, and that will be they'll get the maturity payment and burn the money, which instead of buying more bonds. And so somebody needs to buy those bonds, because what the Fed is doing, they're just an investor. So imagine just any random investor decides not to buy bonds anymore, somebody has to make up the gap, and the Treasury can lean by choices of issuance. They can issue 30-year bonds, they can issue 5-year bonds and 2-year bonds like they did today, or they could issue bills. They just have to tap where liquidity is. And if you tap the bills market, and there is ample liquidity in the bills market, which that's a question we'll come back to, you have very limited effect on long-term assets. But if you tap the 30-year bond, for one, the 30-year bond for the same dollar amount has tremendous more risk premium and volatility, and common holders who own both stocks and bonds, whereas bills compares to money market funds, compares to deposits. 30-year bonds are risky assets, and people have to say, do I want to own where am I going to find room to add more risky assets to my portfolio, regardless of what they are? And so Janet can affect the supply of long-term assets by choosing bills. And the important part of that is, if she were to choose bills, there is pent-up demand that has accrued since the fiscal spending hit the world in 2021 into a program called the RRP, which is the reverse repo program of the Fed. And they have, as of this morning, $1.68 trillion of cash, essentially cash, that is earning interest paid by the Fed, which is then paid by the Treasury, in overnight repo. And that money would prefer, well, prior to March of last year, that money didn't exist at the Fed. Since then, it's grown to this huge number, and it belongs in the bills market. And so Janet can tap that, and that's 2 years worth of quantitative tightening that she can finance with bills and have no impact on asset prices. Of course, if she were to do that, that would sort of defeat the mandate of tightening monetary conditions and hitting assets, which work through the wealth effect. If you hit assets, the wealth effect means that people don't consume as much, particularly people who own assets, which again are the wealthy typically. And that can quell inflation. So if she were to do that, it would be contrary to her mandate. So it's unlikely that she will, but that liquidity belongs in the private sector in securities holdings. It doesn't belong at the Fed. And so that's what I'm looking at. And depending on the mix of issuance that the Secretary of Treasury announces on May 2nd, which is when the quarterly refunding announcement happens, we could see either, sort of the long predicted sell-off in a portfolio of assets, or a bounce in assets, depending on how much she pulls the lever, or if she pulls it at all.
Yeah. So just to summarize real quick, it sounds like you're saying Powell and Yellen definitely need to work as a team in these upcoming months, because if not, she pulls a lever, we see a complete contraction of all multiples and everything drops in the price, correct?
Yeah, and that's a question. It depends on what their outlook is. I think both of them, and I might be wrong about this, and they certainly changed their mind through time, believe that inflation is not as big a problem as the market does. Yet politically, both of them are in the hot seat in terms of fighting inflation. So if she does issue bills, that will be against the inflation fighting mandate of the Fed. And so they're actually going to be working at cross purposes at that point. So at the same time, the Fed cares about what happens to market prices too, and knows the wealth effect has limited impact on inflation, while cost of borrowing, which is what the short rate hikes are doing, is very effective in fighting inflation. And they don't want financial turmoil any more than anyone else does. There's no really valid economic reason, if you're fighting inflation to use the weak tool of crashing the market. There might be a political reason to crash the market. I don't get that one, because that one seems like you crash the market and the Republicans say you crash the market. If you don't crash the market, the Republicans are going to say you didn't fight inflation effectively. So the politics is a double-edged sword. So again, I'm not making a prediction. I don't think it's predictable. I think what I do think is these two people know exactly what their actions are going to do. And both of them agree that hiking rates affects inflation. And both of them agree and have stated that quantitative tightening is not designed to fight inflation, nor is it desired to crash the market. It's just desired to reduce the balance sheet so they can do QE again if we find ourselves in an economic crisis again.
Yeah, and just to tap off of that, I mean, there's already predictions that they're raising rates just to cut them again here in a few years, which is probably the QE you're referring to, right? I mean,
that's certainly true. I mean, there's no doubt about it. Having rates at zero leaves you no tools except quantitative easing. Having the balance sheet at 9 trillion leaves you very limited quantitative easing. So you got to get both of those things in a place where you have tools again. But at the same time, the economy requires it. We're going to have very strong nominal growth this year, which is, to my view, going to fuel equity earnings, because a combination of inflation and reasonable GDP growth, not nuts, but a couple percent, are going to fuel 6, 7, 8, possibly 9% nominal growth. So the economy's humming, jobs are humming, and we have this inflation spike, which may be transitory, may be supply related, who knows? I think we all know that there is inflation. It's just a question of whether it's year over year over year or just a short-term surprise. So the economy needs the hike in rates to cool it a little bit.
Yeah. So Andy, sorry to interrupt. I just want to translate this. I mean, in regards to the market, you're talking about earnings increasing and the market is humming, and that kind of would tell a lot of people to stay within equities. But then also there's the worry that we just talked about Yellen and Powell. So I'm just kind of wondering, like, how are you positioning in an environment where you're like, well, it could go this way or it could go this way? What should our investors, our audience, be thinking about?
Well, I'll tell you what my positions are, and then I'll tell you why. My positions are long Nikkei, long SPX, long NDX. I bought 30-year treasuries on Friday evening at the close. And I bought Eurodollar futures at the close as well, expecting a parallel shift of the yield curve slightly lower rates, as I thought the bond market had overdone it. So at some level, I'm hedged in terms of interest rates, and that if they rise, my bonds if growth continues to drive interest rates higher, my stocks will do okay. One other thing, I'm short yen, and I've been short since 116-ish. That's obviously a fascinating easing story. And then lastly, I have an oil trade where I'm short 3-month oil and long 3-year oil. So that's how I'm positioned. And I fully expect before May 2nd to have radically different positions. And I don't know what they will be, but I'll be light, because the outcome of the May 2nd quarterly refunding, which is simultaneous to a Fed meeting, is going to just be too much information to walk into blind without it being able to predict.
That's great insight. Obviously, I mean, there's so much we could talk about, Andy. I really appreciate your time. I'll let you get on with your day instead of just keep you here forever and just ask you questions about what's going to happen. But really appreciate it. I know our audience does as well. Andy Constan, CEO of Dan Spring Advisors. Thank you so much, Andy, for joining us today.
Sure, Daniel. Pleasure.
We'll talk again soon.
See ya.